everyone. Welcome to Retire with Style. I'm Wade. I'm here with my trusty co-host Alex, and we're going to be continuing an arc on alternative investments. Specifically today, we're going to get started on talking about hedge funds. Before we get into that, though, we do have the YouTube Live coming up. It'll be June 2nd at 2 p.m. Eastern. It'll be a chance to ask us questions in a live setting on YouTube, and I'm sure after that, hopefully we'll get a nice backlog of questions that we'll have a few episodes on Q&A subsequently as well. But we're looking forward to that June 2nd, 2 p.m. Eastern time. And hey, Alex, you're going to be the one doing the talking today. So welcome to Retire with Style.
All right, Wade. Hey, man, you shouldn't warn people that I'm going to be doing the talking, because that means everyone will either listen to this at 3 times speed or just go to the next episode, right, Wade?
It's an Alex-centric episode for those keeping track.
But yeah, everyone, for that YouTube Live, please start sending in questions, because it helps us prioritize and collate them in a manner that we can talk about relevant topics at once, as opposed to being scattershot all over the place. But yeah, we love to do the Q&A radio time. That's when we try to be Dave Ramsey, shall I say, or Rick Edelman? Which one do we try to be, or Susie Orman?
Maybe none of the above. Although I've never actually heard Rick Edelman's show.
I have for like a couple minutes at a time, and I don't know. That's not a good or bad thing. It's just one of those that when you live this for your employment, the last thing I want to do is drive home and listen to it some more, kind of thing.
Well, right? I think he's a bit more serious than the other. Although I don't even know.
Although if you're an advisor listening to this, please don't stop. I realized while I was saying that, like, oh my God, I made a terrible mistake.
All right. No take 2 on Retire.
So I needed to hedge. Wait, that's a great segue.
A good segue into hedge funds.
Yeah, and today we introduced the topic of alternatives, and the granddaddy of them all right now is hedge funds, and these are things that are in the nomenclature, right? Hedge funds, and it started with what is a hedge fund? You know, they need to hedge, and so we'll talk about that in a bit. But I think the definition, at least in the nomenclature of hedge funds, have grown beyond just investment vehicles that hedge their bets, right? We'll talk about those that truly hedge, but it's one of those things I wanted to put out there. In essence, though, I mean, think of them as private funds, and they're actively managed investment funds that use various strategies to generate returns. Think about mutual funds that are more unshackled. Not that mutual funds need to be shackled, but there's certain regulatory requirements just to make sure that everyone's on the up and up, that that provide these sort of shackles, like limits on positions that these funds take, et cetera, et cetera. Those are not present, when you have a hedge fund, because of the nature of how they are. Right.
With our discussion last week, you do need to be an accredited investor, and
you're right. Yeah, I was thinking more investment strategy wise.
Mm-hmm.
Now, what's their goal, right? Now, again, saying hedge funds is akin to saying mutual funds. There's many types. There's not just a hedge fund is a hedge fund. There's some that are ultra conservative, frankly, and there's some that are ultra aggressive, and everything in between, in a similar manner to mutual funds. So when folks just say, make a blanket statement like hedge funds are terrible, they're too aggressive, those folks usually probably don't know what they're talking about. I mean, they could sort of poke at the structure of them and the transparency of them and things like that. That's fine. But in terms of the investment mandate, they run the gamut. And so it's just not enough to say I have a hedge fund or I'm thinking about hedge funds. Again, that's akin to saying I'm thinking about mutual funds. I mean, and we're waiting, kind of response. And so a lot of these, what you'll see is they aim for absolute returns. They seek, because they're placing bets on, I have this, I'm able to forecast, or I'm able to identify some sort of mispricing that others aren't, and I really don't care which direction the market is heading, because I can make accommodations from that, because I'm no longer a mutual fund, to to use certain products that may hedge or may not, or may amplify as opposed to hedge returns. Now, so they seek market gains regardless of the direction of which it's going, right? And like I said earlier, unlike mutual funds, they have fewer regulations. They can use leverage and derivatives. All
And
right.
the shorting positions too, right?
Yeah, they take shorting positions, and I'll talk about what that is in a bit. But yeah, they take on leverage, short positions, whereas mutual funds, cannot, right? Now, because of that flexibility, they're able to enhance their returns. But before I get into short positions and getting into tactics, let's talk a little bit about fee structures, the admin piece of this.
Yeah, and on the fee side, that's something that maybe a lot of folks have heard the idea of the 2 and 20 fee charge.
Yeah, exactly.
Talk about what that is.
That's coming down over time simply because they're more accessible. When things are more accessible, there's more competition. When there's more competition, all of a sudden people aren't as smart anymore in terms of being able to charge for their services, if you will. And so it's traditionally you get a 2% management fee, and they'll take 20% of the profits, right? And so that could be very expensive because let's say something returns 10%. Well, whatever you've invested in, you're going to get charged 2% of that in the management fee. And then in addition, they're going to get another whack at it where you take 20% of the profits. Now, some of these, when
Do
they
they
do that,
refund 20% of any losses?
yeah, well, this is what I'm getting at. Some of them have watermarks. And watermarks are effectively like, let's say there is a loss 1 year, then they can't take their fees unless they hit a watermark that effectively breaks them back to even, right? But the reality is a lot of these funds their cost structure is dependent on taking profits every year. And when that's not there, these folks fancy themselves as masters of the universe, right? When that's not there because they had a bad year for whatever reason, some of them will tend to close down the fund and just say we're done. And all of a sudden open up a new fund in which they're not subjected to that watermark anymore, which is another caveat in which, buyer beware comes investing in hedge funds. Obviously, in any normal, I'm not saying that's everybody, but in any normal distribution of a population, you're going to have your good folks, you're going to have your bad folks, and you're going to have your folks in between. And, when you look at the incentive structure, where lion's share of their revenues are going to come from the profits, and you notice some people don't make it, and it's going to take them probably 2 years, 3 years to recoup that until they can even charge a fee. They're human beings, and it's very easy to just shut it down and then start again 6 months later with a friends and family round or something along those lines. All right, so you have to keep that in mind. That being the case, though, these are coming down. And someone could say, well, if they're providing value and they're providing alpha year after year, well, they should charge everything up until that alpha amount, right? There's that argument too as well. And you're right. If you can provide me, if you can outperform the market every year, regardless of market movement by, I don't know, 10% a year, then you would think they would take all these cuts because why not? And you'd be happy to pay for it. The issue is, are these things actually something you can count on year after year? And if not, then what happens, right? But again, there's a lot of movement where some of these are called hedge funds, but they're really, and I'll talk about it later, they're really kind of taking alpha and turning it into beta with systematic trading processes. And the people that are doing that are naturally lowering their fees because they're mimicking those trading strategies and they're getting very similar results, if not better, because they're taking out a human component. And then all of a sudden, people are asking, why am I paying you for something that could be automated? Like, quote unquote, like an index, like an active mutual fund versus an index mutual fund.
Mm-hmm.
When, year after year, they underperform, active managers underperform, and you take that over a 5-year period, the numbers are staggering. Why would you want to pay 1.25% in a management fee when an index fund at 0.1% will provide better returns, right? And so you see this race to the bottom. And, do you see a race to the bottom in hedge funds? I don't know. My finger's not on the pulse to that extent where I know the entire universe and what they're being charged, but there is a downward trajectory, not an upward trajectory.
Well, no,
And I'm
race to the
sure
bottom
results
makes
vary
it,
based on who we're talking about. Wait.
a race to the bottom makes it sound negative, but it's really a good thing for the consumer that
Yeah.
a
I mean,
race
a race
to
to the bottom in
lower
terms of
fees
fees.
without sacrifice of value. So it's
Yeah.
good for the consumer.
There you go. Now, hedge fund performance, how do they do? Are there magicians out there? I mean, look, you know where we stand with the active and passive, and part of my argument is, sure, there may be a Michael Jordan out there that's, demonstrably better than anyone else, but guess what? You're not Michael Jordan, and Michael Jordan doesn't want your money. You know, is kind of my take on it, at least after a certain point. Why would he want that? And if he was taking your money, he'd charge you up until the amount that it would make him an average basketball player, if you will. And so it's tricky like that. But you do see, you do see numbers. You see a lot of times tear sheets where they're saying, look how this fund performed and the like versus the index of available hedge funds and things. Now, I have issues with that simply because a lot of these hedge fund databases suffer from survivorship biases. A lot of these funds, unlike Morningstar, when they're looking at mutual funds, the funds that died are in the database, right? And so that's going to hurt the aggregate performance. Let's say you're looking at 10-year mutual fund performance, and completely making this up. Let's say the index performed 10% and the average active fund performed, I don't know, 7%. That 7% return is taking into account the funds that are no longer in that database, that died, that closed down 4 years into, 4 years before the 10 years were up, right? When you're looking at some hedge fund databases, last time I checked, that stuff was rampant, in which those funds take themselves off the count. They're not in that database, so you're getting this overinflated sense of performance. Some folks, those returns, some databases, they require auditing and the like, but that's not 100%. And so I personally always look at these returns with a grain of salt. The other piece is sometimes when you're looking at non-normal trading strategy, non-normally distributed trading strategies, things along those lines, when you're using leverage, when you're using things like that, it's hard to compare them against traditional measures of risk like a Sharpe ratio and things along those lines, because you would have to accommodate for those. And when you do that kind of stuff, you really, things start getting fuzzy, if you will. And in addition, like I said, what are you comparing the returns to? Right? Because if you can take the systematic trading strategies, if you can take trading strategies that folks are doing and calling it alpha and systematically replicate it, which is effectively turning it into beta, then really on a risk adjusted basis, there's probably some factor that they were just exposing themselves to systematically that led to those higher returns. And if you can get that systematically, then there really was no alpha to be had. Maybe they identified some sort of trading strategy, but markets work and they become replicated. And where's the value is what you have to ask yourself. And the last piece is how they report and things along those lines with regards to the use of options and the like. There was a couple of research papers. The granddaddy of them all was Do Hedge Funds Hedge, I believe, by Cliff Asness. And what he looked into was creating a lag in the returns, a 1 month lag. And what that means is if a fund, says I return 10% this year, from January to December, well, you know what? Let's do from February to January, where you create this month-long lag. And what you found is when you did that, the hedge funds, many of the equity-driven hedge funds were actually, their betas shot up through the roof. There was this lagging component when compared to the market. And so you have to ask yourself, is this a reporting trick? And by trick, I don't mean any malfeasance. I just mean, is this just some quirk in the reporting? In terms of getting the true value of all the assets, especially when you're not just 100% dealing with liquid securities and the like. And it kind of looks that way a little bit. Again, that's not saying there are not some that are outperforming like crazy. And I'm not trying to take this completely cynical view of the world. But there are all these things that you have to consider within the orbit of, is the performance really there, right? And so the performance history is tricky because survivorship bias in the data. risk-adjusted returns versus just basic, compared to index tracking, especially when you're dealing with publicly traded securities. And then correlation considerations, because if you lag their performance by 1 month, the correlations to the markets shoot up. And so what are you really doing? Because at the end of the day, you don't care that you're at a cocktail party saying, look at this great hedge fund that I have. You care about your nest egg, and you care about the actual return that's being manifested and the risk that's being reduced for that. And you want to make sure that's always there. And sometimes you see it and sometimes you don't. And I can't in my humble opinion, for me as a professional, I can't say wholeheartedly, yes, hedge funds usually tend to outperform and they diversify, from the markets. I can't say that either way. It has to be on a one-by-one basis. If you're asking me, in which I'm really looking under the hood and seeing the sources of those returns and then comparing them accordingly to the right sources to see if there was any value. Will the normal consumer do something like this? I don't think so. Wade, right?
No, I mean, well, you've got to be accredited investors in the first place.
All right. Will the normal accredited investor consumer do this?
Okay. Probably not. Still.
Probably not, right? Although I know retirement researchers are a different breed.
Oh, yeah.
But for the most part, I don't see that. Now, there are many hedge fund strategies. Let's go over some of them. This will be a two-parter.
Mm-hmm.
So there's long short, which is a real term where it came from, hedge funds, right? Long short equity strategies, market neutral approaches, which is a little bit of a kissing cousin, if you will. Quantitative hedge fund strategies. These are the the high frequency traders that you read about all the time. Oh, that's just one component of that. Global macro hedge funds. Those are the ones that you see a lot about in movies and things like that, where they're really moving chess pieces around and playing the three-dimensional chess of the world economy and seeing where there's an opening. Event-driven strategies, which those can frankly be quite conservative. And managed futures, which are largely trend-following strategies, usually around commodities and things like that. All right?
Okay, so that was 6 different strategies that you'll be going into. Although
Yes.
not all in this episode.
Not all of them in this episode. Here, we're going to try to focus on long short, market neutral, and quantitative.
Okay.
All right? So long short. Long, just to define that, long is really what 99% of investors do. They buy a stock. Well, I'm just saying 99%. I don't have an actual number behind that. But for listeners of this podcast and consumers, accredited or not.
The nickname for Wade and Alex? Long
yeah, exactly. Oh, yeah. Hey, that's not funny, man. Yes. Yeah, Wade is like, how tall are you, Wade? 5'11", 6 feet, something like that?
Yeah, I'm not particularly tall.
Yeah, and well, thank you for that statement, Wade, being that I'm 5'5". So I guess I'm the short and Wade's the long. But effectively, what it is, long is when you just buy and hold. You're buying it. You're long the position. You're buy and hold for the long term. I would imagine that's where that came from. Short is when you're betting against a stock. And so what happens there is effectively, and you see this a lot, short sellers are being squeezed or things like that, right? And so let's say, to give you an example of going short a position is, let's say a stock is selling for $10 a share, right? And I want to buy, and I think it's going to go down, right? And so what I do is I'm going to pick up 10 shares. I'm going to borrow 10 shares. I'm not putting any money down. I'm going to borrow 10 shares. And you could do this. Schwab, Fidelity, mutual fund companies, all of these people, some of these trading platforms now, they make their money off of the interest from borrowing shares. So even though you have shares of a stock at Fidelity or whatever, they can take those shares and borrow and lend them to somebody else, even though you still own them, right? That kind of thing. And so effectively, I want to go short stock XYZ. And so I'm going to do 10 shares. They're they're selling at $10. I'm going to take 10 shares. I'm short $100, right? I'm going short 10 shares of this stock because I think it's going to go down. So what I do is I borrow the 10 shares. I didn't pay money down. I'm borrowing 10 shares. I have to pay interest on it. And if it goes up at a certain point, I'm gonna have to return those shares, and that's where they get squeezed. But for the most part, all right, I'm going short. Let's say the stock in a month loses 50%, right? And so now what was $100? Those 10 shares were worth $100. 10 times 10 is 100. So now a month later, it's gone down 50%. I was right. It went down 50%. What I do is all I have to do is return the shares. I'm paid interest along the way, but as long as I return the 10 shares, guess what happens? I effectively borrowed $100 worth of stock, right? I only have to repay $50.
Is this, you're going to borrow them, sell them, and then repurchase them to pay them?
I'm pretty much just paying back $50. So I keep $50. Voila, there's your miracle, if you will. That being the case, if it goes up, they can be called, where they say, hey, you have to pay these back. And all of a sudden, let's say it goes up 50%. Now all of a sudden, I have to pay back $150, not $100.
And that's a problem because you don't own the shares. Or you've sold
I don't
them.
own the shares. I have to buy them.
You can't just
exactly.
return the shares.
I have to make that trip. And so effectively, that's when you get short squeezed. But what you're seeing is, why would anyone do that? And why should that be a good thing? You could say it's a good thing or a bad thing. Sometimes some governments actually like to prohibit short selling. But the reality is it's a price discovery mechanism. A lot of fraud is found when people take short positions. Why is this person thinking that this stock is going to go down? And then people start looking into it more and more. Really, if you love accounting, then shorting is in your blood, right? But that's ultimately what you're doing when you're taking a position short. So a long short strategy is you're investing, right? And some of your stocks are long, and some of your stocks are short. And I'll get into that one in a little bit. I just want to define long short. Market neutral. I'm doing this one together because it's a little bit of a kissing cousin, so I want to introduce both of these a little bit.
But just before that one, so the idea is traditionally mutual funds are just going to take long positions, and so you can only bet on buying stocks you think are going to go up. With a long short world, you have the potential to bet on stocks you think are going to go up, and also bet on stocks you think are going to go down. So you have more optionality for your investment choice.
Yeah, and there's going to be a net position. Are they net long on the market? You could have 80% of your stocks are long, 20% are short, etc. So what's your net ultimately? So there's a market direction there that I want to make clear. Market neutral, you're balancing long and short positions based on what you feel are their price discrepancies that are going to sort of coalesce a little bit more, right? And so you're trying to actually minimize overall market exposure. So it's market neutral. And you're really looking at the price differences between them. You think there's an anomaly in the price differences, and that's where you're going to make your money on. So it's a little different, but you're using both long and short strategies to be able to accomplish that. All right. So long short, well, here, I'll talk about it a little bit more. So in a long short position, right, you aim to capture alpha, both on long positions and on short positions, right? You're almost like agnostic. Hey, I think this stock is going to go up. I'm going to buy it. I think this stock is going to go down. I'm going to short it. Those two positions don't necessarily have to have a relationship with each other, nor are you concerned about the overall general market direction. Although, the reality is if the market tanks, every position will go down. If the market goes up, it's hard for every position not to go up. And so there is a balance where there is some directional approach, and that's where you are you net short, net long? You do that to kind of protect yourself. So, but you are still reducing market exposure while getting equity-like returns, right? It does help hedge against bear markets, but hedge, not immunize yourself, which a market neutral strategy tries to do. Okay? And again, you can imagine now the type of skill needed for this. There needs to be a significant amount of skill to be able to do this. Now, it's relative to the skill needed for market neutral, but you still need this, right? And so think about if you have a long short fund, this is interesting for investors seeking equity alpha, regardless of downside, with some downside mitigation. What I mean by that is, hey, regardless of the market, I want this money manager to make money for me. If markets are going down, I want him to pick the ones that are going to go down, the most. If markets are going to go up, I want the ones that are going to go up the most. If markets are kind of doing their regular thing, I want him to be able to disentangle which ones are going to go up, which ones are going to go down. Okay? And so there you go. That's long, short kind of position. Now,
and well, on that topic too, like whole GameStop saga, for example, is a case of this, where hedge funds were going short on GameStop because they thought the price was going to go down, and the retail investors all got together and went long and pushed the stock price up, and that causes a lot of pressure for the short sellers because the stock can go up an unlimited amount, and so the amount you need to potentially pay back can be enormous.
exactly. They're uninsured for the upside. It can go up forever and ever. And so eventually they call, and frankly, those shares are borrowed. And so Fidelity at some point may want them back because they don't meet their covenants and things like that. And so all of a sudden they got to produce the shares from somewhere. And so they have to buy it and then return them. And so that buying pressure causes the stock to go up, which that's what they mean by they're getting squeezed, in that sense. But you're right. That happened with GameStop, where it was a game of chicken between the retail investors and these hedge funds. And you're right. GameStop, you can make the case. Why was it going up in the manner that it did? It wasn't supposed to. And so, these folks are looking at balance sheets thinking this thing has to go down because it's pure, it's a sandcastle. And someone had different ideas. All the retail investors kind of knew this, and they were like, no, you know what? We're going to continue to make it go up because we know that we're going to squeeze you and we're going to get another 20, 30% out of this stock just because of this logistical workflow that you're in right now that you're going to try to unwind. It's effectively, it's the opposite of when somebody has to, somebody has to sell and the stock goes down and down and down because you can drive that price down. It's just the same idea, but in the other direction, because they're borrowing the shares. They don't actually have them. And so if it goes up, to Wade's point, it can go up indefinitely. It can go up to 1,000, to 10,000. And where are they at that point?
And that's why short selling, it can be riskier than going long, because with going long, you could lose your entire investment. But when you go short, you could lose more than your entire investment.
It's the furthest you can go. The floor is zero if you go long, unless you're doing it with leverage. The floor is zero. If you go short, the floor is more than zero because in terms of your net worth, because it could go to $1 million and you may only have $100,000, to be able to buy stocks, to be able to buy the stocks to then return them, etc.
Mm-hmm.
So is this now what's happening here? And the reason we're doing this is there are some strategies, albeit to a lesser extent, available. Now, Wade was saying this earlier. We're talking about accredited investors and things like this. But what you're seeing now with technologies is you're seeing access to things like this for the consumers, if you will. And, and this is not to say do this or not. By no means is this an endorsement. Wade and I have our McLean hat on and our retirement researcher hat on, which those are registered investment advisory firms. So by no means are we promoting this or think this is what you should do. This is just to be an informed consumer. But there are beginning to be platforms where consumers can access this themselves. And frankly, even through advisors, as long as you're accredited investors, there's these platforms that are coming out for advisors that are providing this universe of hedge funds and illiquid securities that advisors can begin to tap into for their clients. So you are seeing this out there in the what's the phrase here?
In the wild.
In the wild, yeah, exactly. You are seeing this out there in the wild, and the reason we thought this would be a great arc to have is because more and more people are getting pitched these strategies, and we, like I said, we have a lot of prospects that come in with these strategies. They don't know what they are, why they're even in it, and the amount that they're in doesn't even move the needle within their portfolio, and it causes aggravation. And so we're trying to help you be informed consumers of just what this is. But know that you're seeing a lot of these things available more through advisors than you ever have, and you're seeing a lot of these just in certain markets available, such as daily liquid mutual funds, interval funds, if you will, and the like. right? And there are some ETFs that track long and short strategies. Like I said, they're turning alpha into beta, and so that's why you're seeing this whole price compression as well. All right.
Okay, market neutral.
Market neutral. So here they're seeking absolute returns. Absolute, the markets go up or down, doesn't matter. We're gonna be able to do this by removing market beta. Now, again, long short equity, but they want a zero net exposure, right? Remember, long short mutual funds, yeah, they're going short some securities, but let's say they think, but in general, we think the markets are still trending up. So we're going to be 60 long, 40 short as a percent. Market neutral, they're trying to offset complete market movements, and their bets are more like, listen, I think the price differences between these securities are such that, historically they're always much closer. They're too dispersed. So I'm going to go long one and I'm going to go short the other. You'd go long the one that you think is, undervalued relative to its historical price, compared to the other one. And you're going to go short the one that you think is overvalued relative to how it compares to the other one. And so you lock out the market and you're just playing on those prices to effectively come together to its historical mean, and hence it's market neutral like that, right? And so it's low correlation to any single market direction because you're equally long one position, short the other. And I'm saying one position, but they do this with many positions, if you will, right? And so this creates the stability during volatile markets because you're just worried about the price movements up or down between a select set of securities. But the net exposure to the market is always kept at neutral. You're not net long, net short, that kind of thing. And so this is ideal for alpha generation in a sideways market, right? Because, when the markets are going up, the markets are going down, you don't know. But if you can play on the price differences between certain securities, if you're able to do so, that's where it makes sense. And that is able to enhance risk adjusted returns without adding equity beta, if you will, because you're neutralizing the market from that equation.
So you're
Now,
trying to
again,
outperform bonds, but with a minimal increase in volatility of performance.
yeah, exactly. Yeah, exactly. You want to say that again, Wade? Because I heard it, but I didn't hear it clearly. But for everyone,
But just you're trying to outperform bonds. Otherwise, you could just be in bonds, but with a minimal increase in the volatility of the performance.
exactly. Now, which strategy is? And again, you're seeing these in a similar manner, for the investing public than you are with long short. Now, which one of these is better, or that kind of thing? Well, in my estimation here, market neutral strategies are ideal. These are all hypothetical statements I'm making, right? They would be ideal for low volatility, steady returns. Hence Wade's bond comment. I'm not saying they're like bonds, but they're not going to give you huge market upside. They're aiming for steady returns, controlling for the market, and the source of those returns are the price differentials between securities that they think are not quite where they should be, right? And so they're often used by institutional investors when they want to diversify from market risk. Long short strategies offer higher return potential because they're going to ride on the coattails of general market movements as well, but there's higher risk around that. So the too long didn't read version is, market neutral strategies hedge out market risk completely by focusing on pure stock selection. Long short strategies, they have that pure stock selection, but they're still taking, based on their net exposure, they're still taking a broader market direction. All right. So in essence, you have a couple of variables here. Market exposure, long short strategies are partial. Market neutral, they want it at zero. Which one has alpha? Well, I would say market neutral is probably the most dependent on alpha because it's neutralizing the market. So you're not going to ride on the coattails of a general market direction. You're riding on the coattails of your ability to find price discrepancies between a group of securities and having those prices move in the direction that you think. And that's a hard ask because you need to have the price of something that you think is overvalued to go down, and you have to bet on the price of something that you think is undervalued to go up relative to each other, right? And so it's a tricky thing. Whereas in the alpha that you're hoping for in the long short there is some of that, but there's also general net exposure that can help you. All right. Leverage. Well, because you're neutralizing the market, in a market neutral, you have to use more leverage to be able to get returns that are greater than fixed income, to Wade's point as well. And so there's usually a little bit more higher leverage in the market neutral, because that's how you sort of amplify that no net exposure, if you will. They both short, from that standpoint. Volatility is going to be higher in the long or short. The market neutral, yeah, it's less volatile because of the way they're able to hedge out the market completely. But is that needed? When you can get maybe a similar return to bonds? I don't know. You have to ask yourself that. And so risk profile, long short, equity like. To me, market neutral is lower risk with stable returns. But again, you have to take into consideration how those sources of risk are developed. And can you replicate that by putting in the bonds and doing systematic things on your own? Most likely, I think you can. But that's where you're at when you're looking at market neutral, long short equity strategies. Wade, anything there that I may have missed?
Well, just a question I have with that fee structure, would that sort of 2 and 20 be common with market neutral as well, since there's less profit potential, and that 2% fee is a hurdle to get over to outperform fixed income?
I mean, the good ones, they do it, but they'll do it because they figure they can make it, and they just lever it up more. They just generate that amount through the leverage they can take in it. But again, 2 and 20 has become this banner that results vary now. That when we were kind of putting this together, I was thinking, do we want to say 2 and 20 anymore? In that sense, what you find when you look into it is based on the expected returns of the strategy and the and the volatility in it or whatever, they're gonna charge you whatever percent and profit taking portion that they can above and beyond what their alpha is. They're gonna always take it to that level. So whether it's 2 and 20 or not, I don't know. I think what's more important is they're taking a fee and they're taking a percent of the return. What that number is depends on the overall structure, but as a proportion to the overall return, whether it's 2 and 20 or like 1.75 and 15, that kind of thing, I think it's a similar kind of ratio relative to the overall expected total return. Does that make sense, Wade?
Mm-hmm.
All right. Arbitrage and quantitative strategies here.
Mm-hmm. Yeah, that's the third broad heading.
Yeah, that's the third broad one. And arbitrage is, you're taking advantage here of these sort of price inefficiencies. Now, that's different than what we were talking about in the market neutral. Market neutral is really just assessing, hey, usually these differences between these two prices isn't the same, so I'm going to lock something in and bet on that to converge, and I'm going to neutralize my overall market exposure. Here, you see this a lot with like corporate events and things like that. Stocks that are dual listed, it's listed like this in one exchange, not the other. Let me quickly, catch that, if you will. Quantitative strategies, they're using data-driven algorithmic models. That's like been all the rage, over the last 10 years, if you will, this sort of convergence of the stats bros coming into the industry and making it all algorithmic, especially with the advent of trading, being able to high frequency trade and things along those lines. Now, with regards to this, there's quite a few strategies around that I want to make sure. And I want to make a point that this is a little different when I talk about arbitrage. It's a little different from the event-driven strategies, because sometimes when there's a merger, and I'll talk about this in the next one, there's an ability to kind of, there's usually a spread. If a company is buying another company and the company right now is $40 and I'm buying a company that's $20 and I'm going to offer $25 a share for it, that company doesn't move to $25 that day. it goes to, like, let's say $23, $24, and there's $1 there that you can say to yourself, hey, there's a free $1 here in return if this deal goes through a month from now. Why don't I go long the company that's $23 and go short the company that's $30, because that'll guarantee me that 1%, that 1 point difference in price, right? That's different than what we're talking about. I don't want to get into it too much right now because that's for tomorrow. That's for another day, if you will. But arbitrage is you're exploiting price differences in these securities, and you want to do it quickly. And think of the example of, let's say, a convertible preferred strategy, where in that strategy, think about here, a convertible preferred where, let's say, company XYZ and a company XYZ issues convertible stock, right? And each preferred share can be converted into 2 common shares of stock, right? And the convertibles are issuing some dividend along the way, some interest payments along the way. That's why they're doing convertible as opposed to, normal bonds or corporate bonds and the like, right? And so let's say the common stock is trading at $30 a share, right? The common stock is trading at $30 a share. So that means that each preferred share should be worth at least $60, because if it's going to be converted to 2 shares of common stock, 2 times 30 equals 60, right? Plus a little extra, let's say, for dividends and things like that we were talking about earlier, right? But let's say the preferred stock is trading at $55, not at 60, right? There's usually something inherently also at issue that is doing that. So what you would do, though, so this is a clean example, but there's reasons for that. But let's just say that the preferred is trading at 55. So you short sell 2 of the common shares, you get the $30, right there. You paid $55 to buy the preferred. You received $60. Effectively, you have that $5 difference right there, right? Because at some point you convert the preferred shares into 2 common stocks, and you deliver that when you close out your position. And so that's what you get. Now that's a basic example, but this is what's going on when you're talking about these sort of arbitrage strategies, right? You're trying to exploit price differences within securities, and there's a speed that you have to do that in, because you have people now combing all these market prices to capture these things, right? And so that's what you get in sort of these arbitrage strategies, right? Or what's the stock trading in Germany? In the German market, it's trading at this. In this other market, it's trading at this. That doesn't make sense. Why don't we buy this one, short the other, and wait for these things to converge, right? Now, there's pennies to be made. I'm not saying you're going to be making $10 a trade here, but these are pennies. And so this is where you get into this, let's do this 1,000 times, And so that, or 1,000, 1,000,000 times. And so that's where you get into these sort of high frequency things. Now, again, arbitrage, they're really trying to seek risk-free profits by capitalizing on these price differences in similar securities, such as convertible stocks or in dual listed stocks. You have to kind of realize that's, at the end of the day, that's what they're trying to do, right? That's the source of return. Quantitative hedge funds, they're just using mathematical algorithmic trading models to just comb the base and exploit inefficiencies. Now, I'll get to what these could be in a bit, and they're not too different from when I was talking about market neutral strategies. They're just doing this on steroids, if you will. They're trying to systematize it as opposed to, market neutral strategies. From a long time, those would be the stock pickers, that kind of thing. Here, I don't think they have that kind of ego. They're just trying to, mathematically put up models that will begin to find things and just agnostically trade on them, right? Now, I can't stress enough, these strategies rely heavily on technology and vast amounts of data to generate small, consistent gains over time. It's that joke, Wade, right? Like, if markets, would you pick up $20 on the sidewalk, Wade, as an economist?
The economists would say it's not there. If it were there, it wouldn't. Someone would have already picked it up.
Yeah, someone would have already picked that. And the reality is the flip side to that is, look, it's not worth spending your whole day looking down for money, because you're going to hurt yourself, and you're going to spend an inordinate amount of time trying to find that. But if all of a sudden you have this vast array of technology available for you that increases throughput by factors of 1,000, that can look down for you while you're walking the sidewalk without you actually looking down, and will scoop it up for you, then all of a sudden maybe it's worth picking up that $20, right? And in essence, that's what they're doing. In a funny sort of way, that's what they're doing. And they're doing this with half a pennies. And they're doing this 10,000. I'm making it up because I don't know off the top of my head. They're doing this 10,000 times an hour. Why? Because it adds up over time. And if you have enough leverage behind that, voila, there you go. Now, if you have enough leverage behind that, then you go back to your long-term capital management disaster that you had in, I think it was 98 or something like that, right? And so that's what you have with these quantitative strategies. Now, there's a couple of them that you want to think about. There's statistical arbitrage, right? And that's where people throw the terms around pairs trading, mean reversion. They're just looking at trading two stocks and trading off of that and hoping that they'll revert to the mean. It's a little less stock picking than the market neutral strategy, because they're just looking at it mathematically. They're not looking at what's the true value of this. This is what I think the true value of this, and this is why historically it should begin to converge. They're just, scouring the internets, scouring the market data and saying, okay, boom, we've got two good ones here. Let's trade off of that. Trend following strategies. They're using momentum based strategies. I'll talk about this a little bit more when we're looking at managed futures. Machine learning models. To be honest, this is beyond my ken. It's not like I'm up to date on machine learning models and high frequency trading strategies, but what they're doing is using algorithms to find patterns, if you will, within the marketplace. I mean, this is where probably the world of David Simon would be. But these freaking guys. High frequency trading and risk premium harvesting. Risk premium harvesting is something that we've looked at, and that's something that I can speak with a little bit of what that is, right? And you hear this a lot, and this is one that many advisors, not many, but there's some advisors that do this, and some advisors that I respect that are doing this. This is something that we're looking at, but we're not actively doing this ourselves right now. Now, to take this and use this as an example, what is risk premium harvesting, right? And that's effectively, well, if you believe in the value premium, which is over the long term, value stocks will outperform more stable stocks. Why? Because they are riskier. Now, there's a lot of research being done that if you add it's not really just a straight up value premium, it's a value premium with a profitability component thrown in, which I tend to buy into, that can still be accommodated for in this strategy, right? But in its basic sense, if you want to do a risk premium strategy, with regards to, using stats and things like that, well, effectively, you look at the cheapest 10% of the stocks based on, let's say, price to book, add in a profitability component to that filter. And what are the 10 most, the on a percentile basis, you got the cheapest 10%. Now give me the most expensive 10% based on price to book with a profitability filter built into that. And I'm going to short the ones that are the most expensive, and I'm going to go long the ones that are the cheapest. And voila, I have my risk premium harvesting strategy. Now, you could say the way I've explained it, you can say, oh, well, that's kind of simple, but it's not that difficult. That pretty much is what it is. And this is what the terms I was getting to earlier. They're taking alpha, and sometimes these strategies are taking what was previously, let's say 10 years ago, thought of as manager alpha, and they're really creating a systemic trading strategy around that and having beta. Now, you can make the case that this one, as opposed to others, may make sense, because if you do believe in these risk premiums, then okay, yeah, you can do this and it should be successful. My issue with that is these risk premiums happen over the long term, and they're making these bets on a yearly basis. And so they're expecting this to come to fruition from one year to the next. So you're going to have bad years. That's just given. You're going to have bad years. You're hoping that after over 10 years, 15 years, this kind of risk premium harvesting strategy played out. Now you can make the case, why don't you just buy a value index if you will, and leverage it up if you want, or just don't do anything and wait. And the answer is right. You can do that. And you won't get the risk premium harvesting hedge fund, but you'll take advantage of the value premium coming through. But that's what that is. Why should it work? Well, if historically cheap companies outperform expensive companies over the long term, then just make that trade every year and hope that the long term is not that long on a year-to-year basis. Right? Wade, thoughts?
I realized I should have asked you earlier in the episode. And usually you're the one asking me, but you've used the terms alpha and beta quite a bit. And to just
Oh,
clarify, beta is like the market return, and alpha would be if you're able to earn excess return above the market, holding the overall market index.
yeah, that's exactly it. Alpha is what's referred to as it really comes from a linear model, right? When you look at a linear model, expected returns equal alpha plus beta, which is the market, if you will, and that's it right there. And now alpha tends to be the unexplained variance. And the unexplained variance is what's attributed to the manager skill.
Yeah, and that's what you're saying. Like in an active management world, alpha belongs to the skill of the manager to select the right securities and so forth.
Yeah.
And what
But
you're saying is now with technology, you're able to effectively replicate that without
yeah, what's
any skill, so it becomes
yeah,
part of the market.
exactly. What's happening with technology and once people are better understanding these strategies, that unexplained variance is becoming very explainable. And so the alpha begins to shrink. But that's where the terms alpha and beta came from. It's just the initials in a linear equation. And alpha happens to be the first one, beta is the next one. But wait, we should create shirts that say alpha is Greek for mythical manager outperformance or something like that. It's mythology, Greek mythology. But yeah, and so again, those are the three hedge fund strategies that I wanted to talk about and just lay the groundwork. And it's not necessarily give it its whole thesis. Again, the whole point of Retire with Style is to make folks informed consumers as they enter retirement for retirement income strategies. And so why are we doing this? This is stuff that the reality is if you're in your 40s and 50s, you've been accumulating, you may have been doing this yourself, you may be realizing, you know what, I should start looking at avenues for financial advice. And if your net worth is big enough, invariably you're going to come across an advisor beginning to pitch hedge funds. And it may have nothing to do with a need that you have, but it may sound great. And so what we want to do is kind of not debunk them because maybe it works for some people, but we want to help folks become informed consumers about what this means. And just the word hedge fund isn't enough. It's what's under it. And so today we went over three types of them. Long short, market neutral. What else? Wait, I'm trying. And quantitative. All right. And those are kind of what you have. In the next episode, we'll do global macro, event driven, and managed futures.
That's right.
Wait.
Okay. Yeah, I think we can take it home from there as well. We'll continue this next week with the other types of hedge funds. But again, we'll have that YouTube live on June 2nd at 2 p.m. Eastern Time. So prepare your questions for that. And we'll catch you next time on Retire with Style.
Later, everyone.